Hello people, let's continue our revision series. So now we'll be revising dividend decision topic. A small chintu pintu cute topic, easy topic, 4 to 5 marks expected, not beyond, usually not beyond that. Let's use that word usually. Okay. Now, forms of dividend, one or two theories there, again not that very important, quickly we'll run by. There are few forms of dividend. One is cash dividend. Cash dividend means dividend is paid in the form of cash. When we say cash, it's not necessarily cash, it could also be a bank transfer. Another one is stock dividend. Stock dividend means giving out bonus shares. If a company issues bonus shares, that is also considered as one form of dividend. Because on bonus shares, company will not collect any money. It is given for free. Okay, that's one. Now, overall or the scope of this topic is dividend decision, guys. Should the company pay dividend or should they not? Will the dividend policy of the company affect the market price of the share? That's all is the scope of this topic. Should the company declare dividend or not? If at all you say declare, how much? So those are the things which we're going to be addressing in this particular topic. Oh. Now, few Mahanubahas, Bavasu, Brahaspatis will come over here. Oh. Same like capital structure, we have relevance theory, irrelevance theory. Irrelevance theory ka argument is dividend policy is not relevant, meaning whether company declares dividend or whether they don't declare dividend, market value of the firm will be same. So the first person who is arguing for this theory is our MM sir. Okay, MM sir has given about couple of formulas here which we need to remember, where P0 means current market price is equal to P1 plus D1 divided by 1 plus cost of equity. P1 plus D1 divided by 1 plus cost of equity. If you do that, you will get P0. It's actually very simple formula. People, you want current market price, no? We have already done previously NPV. How do you get the basically like present value? Take the future value and multiply discount factor. That is what MM sir is saying. As if you are an equity investor in one company, you may get some dividend in future. And by selling the shares, you may get some money also. So P1 plus D1 you take. But what is this P1? This is the price of the share now or after 1 year? This is the dividend now or after 1 year? I mean, these two are what value? Future value. But we are finding future value or current market price of the share. So take the future value and multiply discount factor. Because what is discount factor ka formula? 1 divided by 1 plus I whole power n. We are in first year, no? So n is 1. Instead of I, they substituted with cost of equity. So basically this formula is nothing but future dividend and future price ka multiplied by discount factor. Expressed in different way. P0 is equal to P1 plus D1 divided by 1 plus cost of equity. That is 1. And value of the firm denoted by V or VF is equal to N plus delta N into P1 minus investment plus earnings, whole thing divided by 1 plus cost of equity. N here stands for existing number of equity shares. Delta N here stands for number of new equity shares issued. So if you take existing equity shares and add new shares, you will get the total number of shares. Total number of shares multiplied by P1 if you do, you will get the market value. In this portion, some money will be used for investment. Some money has got added in the form of earnings. But all these are current value or future value? Future value. So divided by the discount factor, you will get the current value of the firm. Again, it's a simple calculation. Future value multiplied by the discount factor. Okay. So these are things we'll apply in problem. Obviously, you have done all this. Correct? No, you must remember this. Okay. Sir, how do you get delta N? Anybody remembers? Delta N is nothing but some extra shares issued. Sir, if company will issue extra shares when they have surplus money or when they need money. When they have shortage and when they need money, they will raise the money by issuing extra equity shares over here. Now, how do you get delta N is? Let us say company has an earnings of 1 lakh. Company has how much earnings? Each. Let's say company has a each of how much? 1 lakh. In this 1 lakh, company is planning to give 20,000 as dividend. 20,000 will be utilized for equity dividend. How much money remains? 80,000. Okay, now. But now company wants to start a new project for which how much fund is required? 4 lakh is required. All numbers are assumed. Okay. We have how much? 80. We need how much for future project? 4 lakh. So we have surplus or we have shortage? How much shortage? 3,20,000. If you have shortage, means we have to raise it by issuing new equity shares. By issuing new equity shares, how much money you want to raise? 3,20,000. This is nothing but your shortage, and delta n is nothing but number of shares issued. Are you issuing the shares immediately or in future? So hence take 3,20,000 divided by P1 you do. P1 means price now or after 1 year? After 1 year. So that way you will get the number of shares issued. Clear, Sarji? This is how we find out the delta n wala portion. To find the value of the firm, take n and delta n, add them together, multiplied by P1 minus investment plus earnings. Whole thing divided by 1 plus cost of equity. Now since sir is a irrelevance theory, whether company pays a dividend or whether company does not pay dividend, value of the firm will change or value of the firm will be same. Value of the firm will remain same. Okay people, this is one type of question which is expected from this chapter under approach. Same under approach, sometimes they will also say, they will not say calculate value of the firm, they will say calculate market value of shares. They will say calculate market value of equity shares. If you only use this portion, you will get market value of equity shares. Because n plus delta n is what? N is what? Existing shares. Delta n is new shares. If you add this, what are you going to get? Total shares. Total shares multiplied by market value of one share if you do, what are you going to get? Total market value. So that is also another thing that they can ask in this particular problem. Okay people. Now this is also same, whether company declares dividend or they don't declare dividend, value of the share should change or it should be same. Value of the firm as well as market value of the share should be same. If you are getting a different value, you have done some calculation wrong. We will do one question on this just to be on the safer side. Can I move on to the next? Next we have some relevance theory. Under relevance theory we have Walter-Serro, Gordon-Serro. Walter-Serro, anybody remembers formula? How do you get the price of the share as per Walter-Serro? D plus R into E minus D divided by cost of equity, whole thing divided by cost of equity. D for dividend per share. R is the rate of return on investment divided by cost of equity. E here is your EPS, whole thing again divided by cost of equity. Okay, I had explained you the logic of all this formula people. Now I'll not go into that. People just will remember the formulas and move on with it. That's enough for the time being. Okay, so now this is one, all the components are fine. Okay, Gordon-Serro. Gordon-Serro, any which way we know the formula, it is just rephrased in a different way. Remember in cost of equity, what was Gordon-Chachaka formula we used? D naught into 1 plus growth rate divided by KE minus G. This was the formula we used to use. Correct na people? Or rather ulta, I think we used to use this. If you want to find cost of equity, so D naught into 1 plus growth rate divided by P naught. Flotation cost will not be there over here, since of cutoff. Whole thing added by the growth rate. Now this will be given, this will be given, this will be given, as well as this will be given. What will be missing? P naught. So can you rephrase the same equation to find P naught? Yeah, growth rate you send it to the other side. Okay, K minus G. P you send it here and K minus G you send it here. So what will be the formula? D naught into 1 plus growth rate divided by K minus G. New formula or same thing? Same wine in the new bottle. Okay. Instead of D1, if you do D naught into 1 plus growth rate, what are you going to get? D1. If they give D naught in the problem, use D naught. If they give D1 in the problem, use D1. So how do you get another formula for current market price? Instead of D naught into 1 plus growth rate, you will directly take D1 divided by K minus G. Any problem, sir? Now one more is there called where price of the share is given by E1 into 1 minus B divided by K minus BR. This is a pure substitute. First of all, E here is what? EPS. B here is what? Retention ratio. First maybe we'll do the denominator. Here what is the denominator? K minus G. Here what is the denominator? K minus BR. How do you find growth rate? B into R. So G is substituted with BR. Okay na sir. So that means denominator is same. E is EPS. E is EPS. B is what? Retention ratio. Now people, if B, that is retention ratio, is 70%, means can you tell me what is a dividend payout ratio? If 70% of EPS, B retention ratio is expressed on EPS people. So 70% of what? EPS. So if 70% of EPS, if you are retaining, means how much is your dividend payout ratio? 30% of what? EPS. Okay, Naji. Now, people, if I do 1 minus b, what am I going to get? Check. B is how much here? 0.7. 1 minus 0.7, if you do, what are you going to get? 0.3 or nothing but what? 30%. What is that 30%? Dividend payout ratio. So that means when you do E into 1 minus B, what does 1 minus B give you? 1 minus B will give you dividend payout ratio. If you take expected earnings and multiply dividend payout ratio, what are you going to get? Dividend paid or dividend expected to be paid? That means by doing this, automatically you will get what? D1. That means all these are different formulas or same thing? Same things expressed in different way. Okay. If they give you growth rate and all directly, we will use one of these formula. If they give you B, if they give you R, then we will go for this particular formula. Comfortable, everybody? So all the three are same. It's just a pure substitute. One substituted with the other. But you need to remember all and use whatever information as given in the question. Depending on that, we'll have to use one of these formulas. Need a minute or okay? Comfortable, everybody? Okay. So let's move on to next one. So remember, Gordon sir and Walter sir had some optimum payout ratio. Anybody remembers that? Optimum. As per Gordon sir and Walter sir, there is an optimum. Same optimum dividend payout ratio. Optimum means ideal. So Walter sir and Gordon sir says, if R is greater than cost of equity. If R is greater than cost of equity. Suppose R is a rate of return on your investment. Whatever project company is doing, on that they will expect some return. Let us say return is 50%. But in order to do the project, company should raise funds. Funds will have a cost. Funds will have a cost. So if you are raising equity shares and the cost is, let's say, 10%. Now you would tell me, this is a profitable project or loss making? Sir, if your fund is costing only 10%, using the fund you are generating a return which is how much? 15%. So it's a profitable project, no? If you are running a profitable project, that means what? You'll distribute more dividend or you like to distribute less? Now think, if a company is doing a profitable business, would they like to do it at limited scale or go on expanding? Because if it's a profitable project, means more and more you do, company will get more and more profit and the value of the firm will go on increasing. So hence Walter sir and Gordon sir says is, if R is greater than cost of equity, when you are running what sort of a project? Profitable project. So ideally dividend payout ratio should be 0. This is ideal. Company may follow ideal or company may follow something else. That is their choice. This is the ideal. Optimum means ideal benchmark ratio suggested by Walter sir and Gordon sir. If R is greater than cost of equity, optimum dividend payout ratio should be 0. If it's the other way around, if return from the project is lesser than the cost of equity, then profitable or loss making. Return, let's say, is 15%. Cost is, let's say, 18%. Then it costs 18% to arrange the fund. From that fund, you are generating a return of only 15. So profitable or loss making? We are not making that much. Yes or no? In that case, my optimum dividend payout ratio should be 100%. Don't continue this project. If at all you have any money, distribute it as dividend. How much? 100%. If R is exactly equal to cost of equity, return and cost, if both are same, then there is no optimum dividend payout ratio, or whatever you pay, everything is optimum. Share price will not change. I'll prove it to you with one of the problems. If these two are same, means there is no optimum, or whatever you pay, everything is optimum. You can pay 5%, 10%, 80%, 100%, 0%, doesn't matter. Share price will be same. This is about optimum dividend payout ratio as per Walter sir as well as Gordon sir. Same thing. This is a popular question. Usually they do ask this. Optimum dividend payout ratio. Then Graham and Dodd model. Graham and Dodd model, where price of the share is given by the formula M into E plus or D plus E divided by 3. M is your multiplier, D is your dividend per share, E is your earnings per share. Okay, people, again, a simple, they've done it all, but one good thing is they'll give you all the data. Just dump it and get it. All these are 1 marker or 2 marker wala question, not beyond that. Okay. All right. Then no linter the splinter. What does linter sir say? Anybody remember? No sir, we learnt it sir, we forgot it sir, then and there only we left sir. Okay, linter sir is trying to say, linter sir is not giving price of the share. Linter sir's ka model only gives you D1. D1 means, first of all, D0 means what? Dividend paid. D1 means expected dividend. So Linter sir has come out with a formula to calculate expected dividend, where expected dividend D1 is equal to D0 plus, open the bracket, EPS into target payout ratio minus D0, whole thing multiplied by adjustment factor or speed of adjustment, they say. This is a formula. Actually, it's a very simple faltu wala formula. Chuma, they have given too much build up. What is this simple thing is, according to Linter sir survey, Linter sir did a survey with many finance manager. What is the outcome of that survey is, Linter sir's discovery was, managers are okay to pay same level of dividend. What did I say? Managers are fine with paying what? Same level of dividend. Meaning last year if they paid dividend of 15 rupees, current year also they are fine with paying 15 rupees. But managers are hesitant to increase the dividend. Finance managers are hesitant. They are not that comfortable in increasing the dividend. That's what Winter sir found when he did survey among the managers. So how did this formula work out is, let us say, last year, I think I've used this example. Last year, company has paid a dividend. Company has already paid how much dividend? 10 rupees. Now people, this year, company is targeting to pay 60% of EPS as dividend. Once more, what is that? Dividend already paid how much? 10 rupees. This year, company wants to pay how much as dividend? Earnings ka 60%. How much ever is the expected earnings? How much ever future earnings will be there? 60% of that company is planning to pay dividend. How much is the future earnings I've assumed? Future EPS, how much I've assumed? 20. How much dividend company wants to give? 60%. 20 ka 60% is how much? 12. Correct? Huh? Sir, last year how much? 10. This year looks like how much? 12. That means, is there any, compared to last year, is there any increase in dividend? Last year 10, this year 12 means how much is the increase in dividend? 2 rupees. 2 rupees. Find out this increase in amount and multiply AF. Find out the increase in dividend and multiply AF. AF means what? Probability factor. AF ka full form is adjustment factor. If AF is 40% means what we are trying to say is there is a 40% chance. There is a 40% chance or 40% probability that dividend will increase by 2 rupees. Chumma, I could have made it very simple now. Take increase in dividend and multiply probability percentage. That way you will get increase in dividend. To that you add existing dividend, you will get the new dividend. Chumma, I could have made a formula very, very simple. Increase in dividend multiplied by probability percentage plus D0. But instead of all that, what is the formula? D0 plus EPS into target payout minus D0 into adjustment factor. Sir, if you do EPS into target payout ratio, what are you going to get? Expected D1. From D1, if you minus D0, what are you going to get? Increase in dividend. There is 100% probability that increase will happen or lesser. Lesser. That is what is denoted by adjustment factor. By doing all this, you will get the totally how much dividend will increase in the current year. To this, you add your existing dividend. Finally, you will get what? D1. That's all this is formula all about. Okay, sir. Need a minute? Okay, now. Everybody cool? Okay, dividend discount model, I'll directly take you through with a question itself. One question we will solve and explain you this. If you want, I'll come back to this formula after I solve the question. Without formula also, you can solve this particular model. And now, I think that's all as a concept relating to dividend discounts. 3-4 formulas. That's pretty much it. Once again, all the formulas, call it out back for me. First, we have theories. What are those theories? Relevance theory, irrelevance theory. Under irrelevance theory, we have MM sir. MM sir, how do you get P0? P1 plus D1 divided by 1 plus cost of equity. Then, how do you get the shortage of funds? From the earnings, reduce dividend. You will get amount available for investment. Compare that with amount required for investment. You will get the shortage. Shortage means you have to raise the funds. So shortage divided by P1 if you do, you will get the number of new shares issued, which only we call it as delta N. How do you get value of the firm? V N plus delta N into P1 minus investment plus earnings. Whole thing divided by 1 plus cost of equity. And if they ask you only market value of equity shares, then it will be N plus delta N into P1. whether dividend is paid or whether dividend is not paid, value of the firm and market value of equity shares will be same. That's the Circa argument. Next is relevant theory. Relevance theory we have Gordon and Walter sir. Under Walter sir, what is the formula to find out the current market price? P naught is equal to D plus R into E minus D divided by cost of equity. Whole thing again divided by cost of equity. Then Gordon's Chachaka same thing, but in a revised format where price of the share is given by D naught into 1 plus growth rate divided by K minus G. Or if they give D1, P naught is equal to D1 divided by K minus G. Or another one, P naught is equal to E1 into 1 minus B. If you do that, automatically you will get D1 divided by K minus, instead of G we will write K minus BR. It's a pure substitute. Walter sir, Gordon sir's optimum dividend payout ratio same. What is that? If R is greater than cost of equity, optimum dividend payout ratio should be 0. If R is lesser than cost of equity, optimum dividend payout ratio should be 100%. If R is exactly equal to cost of equity, then there is no optimum, or whatever you pay, everything is optimum. Price of the share will remain same. Then Graham and Dodd model, where price of the share is given by M as in multiplier into D plus E divided by 3, M for multiplier, D for dividend per share, E for earnings per share. Then Linter-Sir's model, Linter-Sir's only gives you the D1 ka calculation, where D1 is equal to what? D naught you take plus EPS into target payout minus D naught. By doing this, you will get increase in dividend. 100% chance into adjustment factor, that is a probability percentage. That will give you your expected dividend D1 as per the Linter's model. I think that's pretty much it. That's what, this one, it's still pending. We'll take care of it in the problems. Okay. Now, can we apply a few questions to learn this? It's a simple, only these are the formulas. If you know, the whole chapter sorted. Now, we'll do one question on everything just to kind of retrace that formula, and then we'll wind up. Question number 1. Again, there's a study material question. I've taken this question and explained all the concepts or all the types of adjustment that can come through approach. AB engineering belongs to a risk class where capitalization rate is 10%. Capitalization rate means here they're saying cost of equity is 10%, because here funds we will raise through equity shares. Whenever we have fund required, no, we are not raising the debt. We'll raise the funds through equity shares. Hence here capitalization rate refers to cost of equity. It currently has outstanding how many shares? Sir, existing shares only we denoted by the symbol N, and which is selling at 100. Currently it is selling at 100 means what is current market price of the share? 100. That only is what? P naught. The firm is contemplating, as in thinking, declaration of dividend of 5 rupees per share. Dividend already paid or dividend thinking? Contemplating means thinking to pay. So this is what? Dividend paid or expected? Expected dividend is D naught or D1? D1. So D1 they have given it to be how much? 5 rupees per share at the end of current financial year. It expects to have a net income of 1 lakh. Net income means PAT basically. But here preference shares will not be there. So PAT and niche will be same. It has a proposal for making a new investment, but the new investment will cost how much? 2 lakh. You need to calculate the value of the firm under two scenarios, when the dividends are paid, when the dividends are not paid. Now people, whether dividend are, since is an irrelevance theory, under both the case value of the firm should be same. That's our that's our final goal. So let's calculate. First formula, how do you get P naught? P1 plus D1 divided by 1 plus cost of equity. Now you tell me, first we'll solve this case. Dividends not paid. So what's that formula again? P naught is equal to P1 plus D1 divided by 1 plus cost of equity. P naught is known. D1 we're solving which case? Dividend not paid. So D1 is 0. Cost of equity given 10%. So which is the missing figure? P1. This formula is used to find out P1. So substitute to get the answer. That's what we have done here. Working note number 1 is to find out the P1, where P naught is equal to P1 plus D1 divided by 1 plus cost of equity. Current market price is P naught. It is given in the question as 100. P1 we don't know. So D1 is 5 rupees. No. Which case are we solving? Dividend not paid. Dividend not paid means dividend will become 0. Cost of equity they gave in the question. Check people, how much was that cost of equity? 10%. 10% in full number will become 0.1. When you solve, you will get P1 to be 110. Any issues with this? Okay, na Sarji. And next we have to find out delta n. Delta n means new shares issued. Sir, we will issue new shares when we have surplus or shortage. Shortage of money. How do we find shortage of money? First, how much is that net income they gave in the question? 1 lakh. Net income means PAT. How much is PAT? 1 lakh. Okay. From this PAT, since there is no preference dividend, PAT only will become ish. Reduce the equity dividend. Which case are we solving? Dividend not paid. So that means the dividend amount paid will be 0. So how much amount is available for investment? 1 lakh. But do we need 1 lakh? How much money is required for investment? The amount required for investment is 2 lakh. We need 2 lakh, but we have only 1 lakh. How much shortage? 1 lakh. Yes, sir, people. If we have shortage, what are we going to do? Issue the shares. You have to issue new shares in such a way that totally how much will recover? 1 lakh. And what is the expected price of one equity shares P1 we got? 110. This is a shortage we'll get in future. So we'll use P1. So 1 lakh divided by 110 if you do, you will get the new shares issued, which we call it as delta N. Okay, na sir? Don't solve this. Only if they ask in the problem, calculate number of new equity shares. Calculate number of new equity shares. Solve this. When you solve this, what are you going to get? 90. Always round off to the next number. Whether it is 0.5 or less than 0.5. Not mathematical round off. Any decimal you round off to next number. So it will be 90. What are you getting? 90? One of you. 90. 909.09. Take it as 910. You always round off to the next number. Not mathematical round off. Just put it off to the next number. So how many shares? 910 shares. Sir, you will do this only if the question asks you to find what? Number of new shares. Otherwise, don't put it in decimals. Keep it in fraction only. It will get nullified in the next step. So keep the fraction. Okay, but did they ask you this or they asked value of the firm? Sir, how do you get value of the firm? N plus delta N into P1 minus investment plus earnings, whole thing divided by 1 plus cost of equity. N is the existing number of shares. How much existing shares we have? 10,000. Okay, updated. Plus delta N. Delta N we just now got it as 1 lakh divided by 110. Multiplied by P1. P1 is how much? From working note number 1 we got 110. Minus investment. How much money we need for investment? 2 lakh. Plus earnings. How much earnings we have? 1 lakh. Whole thing divided by 1 plus cost of equity. Now why did I ask you to keep fraction is? 10,000 into 110 is how much? 10,000 into 110 is how much? 11 lakh. Now 1 lakh divided by 110 into 110 if you do this 110, this 110 will get cancelled. So what will remain? 1 lakh. That way you don't have to solve the decimal, keep the fraction. Minus investment 2 lakh plus earnings 1 lakh divided by 1.1 if you do, you'll get the value of the firm to be 10 lakh rupees. Easy na Sarji? This is value of the firm. By chance, if they don't ask value of the firm, if they ask you market value of equity shares, here not asked, by chance, what you will do? Yeah. N plus only this portion of the formula, N plus delta N into P1. What is N? 10,000. What is delta N? 1 lakh divided by 110 multiplied by P1. If you do, you will get how much? 12 lakh. This is another way of asking the same. One more requirement they can ask from MM. I've just solved it just for our reference. Now all this we solved under which case? When the dividends are not paid. Now same thing we'll have to solve when the dividends are paid. And how much is the company planning to pay dividend? 5 rupees. Okay, so let's solve that. This is a dividend paid wala case where P0 is equal to P1 plus D1 divided by 1 plus cost of equity. Current market price P0 is given. How much is that? 100. P1 we don't know. How much is dividend per share? Expected dividend per share D1 is how much in this problem? 5 rupees. This is dividend paid wala case, okay? And the company is thinking to pay a dividend of 5 rupees. So it is D1. Divided by 1 plus cost of equity. Solve. How much are you going to get? 105. Any problem? Now, next case, delta N. How do you get delta N again, people? Walk me through. First to earnings. How much is the earnings we have? 1 lakh. This is your PAT. Preference dividend not there. But is company planning to give dividend? Yeah. How much dividend? 5 rupees per share. How many shares we have? Currently we have how many shares? 10,000. On 1 share 5 rupee dividend. On 10,000 shares, how much dividend? 50,000. So in 1 lakh, totally 50,000 will be utilized for equity dividend. So how much remains? 1 lakh minus 50, remaining amount is only 50. But how much we need for investment? We need 2 lakh, we have only 50. How much shortage? 1 lakh 50,000. If you have shortage, we have to raise new equity shares. That only we're calling it as delta N. How much is delta N here? Shortage divided by P1. 1 lakh 50,000 divided by P1, which is 105. Solve the decimal or keep the fraction. If they ask value of the firm, keep the fraction. Sometimes they will say find out number of new equity shares. In that case, solve it and take it to the next number you round off to. Next, value of the firm given by the formula N plus delta N into P1 minus investment plus earning. Whole thing divided by 1 plus cost of equity. N is the existing number of shares, which is 10,000. Delta N is this, which we have copied. P1 is 105 minus investment is 2 lakh, earnings is 1 lakh. Whole thing you do, you'll get the answer. So when you solve it, do you think you should get a different answer? It's the same answer. Here you got 10 lakh means here also you should get 10 lakh. If you get a different answer, somewhere you have done something wrong. So don't proceed, correct the error. Done, Sarji. What about market value of equity shares? If they ask that, what you'll do? Only this. Solve that for me and quickly tell. Only this portion of the formula. N plus delta N into P1. If you do it, how much are you getting? 12 lakh. Previously, what did you get? 12 lakh. Different number or same number? So that's what I said. Value of the firm as well as market value of equity shares. Whether you pay dividend or we don't pay dividend. Answer should be same. These are the ways through which, or these are the things that they can ask from approach in the dividend decision topic. Beyond that, I don't think so you'll get anything. Whatever we have solved, that's a maximum scope of approach in dividend decision. Need a minute or next? Next. Easy only, no? All these are faltu problems. Next, you need to calculate using Gordon Search model. Check following figures, again study material question. Following figures are collected from the annual report to net profit. People, net profit always means PAT. How much is PAT given? 30 lakh. But here we do have preference shares. Keep in mind, how much is preference shares? 100 lakh. What is this 12%? Rate of dividend on preference shares. Number of equity shares, how much? 3 lakh. Rate of return on investment, which is nothing but R. How much? 20%. Cost of capital, cost of equity is given to be 16%. Now, you need to calculate price of the share using Gordon's model. Is growth rate given? No. But R is given. And dividend payout ratio is given 25%. So 25% you're paying means how much you're retaining? 75%. What you're retaining only we call it as B, no? Correct, no? So if D is 25% of EPS means B will be 75%. One case or three case? First, when dividend is 25%. Second, when dividend is 50%. And then dividend is 100%. Tell me what will be B in each case? 25% if you're paying means how much are you retaining? 75%. 50% if you're paying means how much you're retaining? Balance 50%. 100% if you're giving dividend means how much you're retaining? 0. Okay, na sir? So B you have. Which formula of Gordon uses B? What is that formula? Price of the share. Price of the share is given by the formula E1 into 1 minus B divided by K minus BR. You have to use this particular formula and update the things. Can we do it? Pure substitute. But one second, E here stands for EPS. EPS given, no, what have they given? PAT. How do you get EPS, people? PAT divided by number of equity shares or ESH? How do you get ESH from PAT? From PAT, first you reduce preference dividend. So first working note is to find out EPS. From PAT, you reduce preference dividend, you will get ESH. ESH divided by number of equity shares will give you EPS. Correct? If you want to calculate, we'll cross check. 100 lakh ka 12%. So preference dividend is 12 lakh. From 30 lakh, you reduce 12 lakh, you will get 18 lakh. Number of equity shares is 3 lakh. 18 lakh divided by 3 lakh is 6 rupees. That is the earnings per share. Easy. Any problem? No. First case mein dividend payout ratio how much? 25%. Sir, if dividend payout ratio is 25% means B is 75% or 0.75. So use that formula E1 into 1 minus B divided by K minus BR. E we just now got how much? 6 rupees into 1 minus B. B is how much? Since D is 25%, B is 75% or 0.75. Substitute. K they only have given, B we got, R they have only given. How much is R they have given, people? R is 20%. Substitute and you will get the answer. How much is that answer, pa? Where it went? The answer is 150. That's what we're getting. Done, sir. Now, next case, only one data has changed. From 25% dividend payout ratio, it has become 50%. Should I have to take you through this or got it? This is the same, no? If dividend payout ratio is 50%, means retention ratio also will be 50% or 0.5. Now, substitute this number and get the answer. Okay. Last is dividend payout ratio 100%. So, B will be, we are not retaining anything. So, B will be 0. Substitute and get the answer. Process or next? Okay. Looks like you have decided that you will go early today. Okay, fine. No issues. This is one good adjustment. Wala question. Check this. Total earnings is how much? 2 lakh. Total number of equity shares is 20,000. So, total earnings is 2 lakh and total number of shares is 20,000. Means what is earnings per share? 2 lakh is earnings for 1 share or 20,000 shares? For 1 share, how much? 2 lakh divided by 20,000, which is 10 rupees. EPS is 10 rupees. Okay. How much is the dividend paid? Sir, in all our formula, we don't need total dividend. We need dividend per share. Total dividend is 1,50,000 on how many shares? 20,000 shares. On 1 share, how much is the dividend? 1,50,000 divided by 20, which is 7.5. That is the dividend per share or DPS. Price earning ratio is 12.5. Price earning ratio is nothing but your P multiple. Correct, people? 1 minute, hang on. Tell me P multiple ka formula. MPS divided by EPS. Correct. Now, people, if you remember, when we did cost of equity, there was dividend price approach. In dividend price approach, how did you get the cost of equity? Name only there is formula. Dividend price approach. Dividend divided by price. DPS by MPS. Next, there was earnings price approach. What was earning price approach? EPS by MPS. Correct? Everyone check. This is EPS by MPS. P multiple is MPS by EPS. That means, is there any relationship between these two? Same ulta na? Therefore, I can say what, sir? Therefore, I can say, can I say cost of equity is 1 divided by P multiple? Formula is ulta, no? Correct, everybody? So, therefore, cost of equity is what? 1 divided by P multiple. So, if they have given P multiple means using this, we can also find cost of equity. So, 1 divided by 12.5 you do. How much is that? 1 divided by 12.5 if you do, you will get 0.08 or 8%. That is what cost of equity. Done, Sarji? Now, what is the requirement of the question? Apply is Walter's model. Stop. What is Walter's model? D. D is dividend per share. We have got plus R into E minus D. E is EPS. D is dividend per share. We have got divided by cost of equity. We have got whole thing again divided by cost of equity. All data we have except R. If you find R, problem is solved. Agreed? R is also given. Can you tell me? Can you just check and tell me? R is also given in the question indirectly. Or we can find that. They have given enough data. R is a return on investment. R is a return on investment. Here we have only equity share capital. We can't use, you are right, we can't use rows, but return on, very simple, sir. How much is your equity share capital? Can you tell me? Number of equity shares is 20,000. Each ka face value 100. So therefore, what is equity share capital? 20 lakh, no? Agreed. So how much money have you raised from equity shareholders? 20. Using the money only you have generated earnings, no? How much earnings have you generated? 2 lakh. Using 20 lakh capital. Using 20 lakh capital, how much return have you generated? 2 lakh. How much is that return? 10%. No, 20 lakh ka 10% is how much? 2 lakh. That only we call it as R. You must have done in your ratio. No, return on equity. There's nothing but your PAT divided by equity. Actually, it is each divided by equity. This is what we used to use. That's all it is. Or you can simply look at it and get it. Total equity share capital 20 lakh. Total earnings is 2 lakh. That means you have generated a return of 10%. Because 20 lakh ka 10% if you do, automatically you'll get what? 2 lakh rupees. Easy na, sir? So R is there. R is how much here? 10%. That's what we've just calculated here. That is nothing but your return on equity. Formula is each divided by equity into 100. How much is each? 2 lakh. Divided by equity. Equity here refers to equity share capital and reserves in surplus. Reserves in surplus there are. No, that means what is equity share capital? 20 lakh. How much return did you generate? 2 lakh. So what is that percentage? 10%. So all the data for Walter Sirs we have got. Need a minute or okay. First I've calculated EPS. Then I've calculated dividend per share. Then using P multiple we calculated cost of equity. Then we calculated R. Now can we read the requirement of this question? Need some time or okay? Alright. Next, read, analyze whether the company is following optimal dividend policy. Sir, 1 second. Walter Sirs and Gordon Sir have both same optimum dividend payout ratio. What is that? If R is greater than cost of equity, optimum dividend payout ratio 0. Here R, how much we got? 10%. Cost of equity, how much we got? 8%. R is 10%, cost of equity is 8%. So what is this? R is greater than cost of equity. So optimum dividend payout ratio should be 0. Optimum dividend payout ratio 0 means company should pay the dividend or they should not. They should not. But here company did pay the dividend. Company has already paid the dividend. And then now they are asking, is company following optimum dividend payout policy or not? Are they following or not following? So that's what you need to justify. Since R is greater than cost of equity, optimum dividend payout ratio should be 0. That means the dividend should not be paid. But however, this company is paying dividend. So optimum dividend payout ratio as per Walter Sirs and Gordon Sir is followed or not followed? It's a theory question. That's all. And don't write one way not followed. Justify. This is important. You need to write little masala you need to put. We are Indians, no. Just like that we can't accept. Little thadka if you put only, then only fun. No. Maja. Next, compute P ratio. Compute P ratio when the dividend policy will have no effect on the value of the share. Read this line once again. Compute the P multiple. Compute the P multiple when the dividend policy will have no effect on the value of the share. Meaning whether we pay 0% dividend or whether we pay 100% of the dividend, value of the share should change or it should not change. When will this happen? Sir, we discussed when R is exactly equal to cost of equity, then there is no optimum dividend payout ratio or whatever you pay, everything is optimum and the price of the share will fluctuate or it will not. It will not. So that means when this scenario will hold good. For you to have no impact on the value of the share, R should be exactly equal to cost of equity. Now stop. R is how much in this problem? 10%. Cost of equity, how much is in this problem? 8%. Which should we keep it as a base? R is 10 and cost of equity is 8. What should we make it? Should we say R should be equal to K is equal to 8%? Or should we say R is equal to cost of equity is equal to 10%? What we should say? R is equal to cost of equity equal to 10%. Pakka na? Why? Perfect. Sir, in cost of equity we have studied. Cost is nothing but return expected by the providers of finance. Today if you are expecting 10%, tomorrow you will expect 10 only or your expectation may change. Your expectation may change. Before marathon you thought it will be wonderful. After attending class only you are getting a full blade. Yes, no, same. Like that only. Yeah? Expectations can change. So cost of equity and all can change. But R is an achieved number. R is a actual number. So which one will you freeze? Cost of equity you will freeze or R you will freeze? R. R is how much? 10%. So you will write what here? When R is equal to cost of equity is equal to 10%. You will not use cost of equity. Which one you will freeze? R. Done na? Everybody good up. They ask cost of equity or they ask P multiple. And we already know between cost P ratio and cost of equity, there is same relationship or inverse relationship. So that means how do you find P multiple? 1 divided by cost of equity. 1 divided by 0.1, how much is that? 10 times. These are ulta relationship. If you want to find cost of equity, what you will write? If you want to find cost of equity from P, what you will write? 1 or where it went. If you want to find cost of equity, we will write 1 divided by P multiple. If you want to find P multiple, we will write 1 divided by cost of equity. Whatever you want to find, substitute the other number in the denominator. Okay, na Sarji? So if P multiple is 10 times, you can pay whatever dividend, share price will be same. Just for your knowledge sake, we've just proved this to you. I have taken 2 cases. You can build 101 cases, your call. Let's assume dividend payout ratio is 2%. Sir, as per this rule, what is this rule again? Tell me. Since R and cost of equity both are same, there is no optimum. Or whatever you pay is optimum, share price will fluctuate or same. Okay, now let's try to prove this. Dividend payout ratio, I've assumed it to be 2%. You can take any percentage. Sir, payout ratio is always expressed on EPS. How much percentage of EPS is dividend, I've assumed? 2%. What is your EPS, people? You already calculated. How much is EPS? 10. 10 cut 2%, you calculate. How much is that? 0.2. So why you took 2%? Some student in Burhaspati suggested 2%. So I took 2. Since it is all this from class notes, I can't change. Okay, na? You can take any number. So 10 is EPS. EPS cut 2% is how much? 0.2. Okay, na ji? This is your D. Now substitute this in our Walter-Sirska model. Walter-Sirska's formula is P D plus R into E minus D divided by cost of equity, whole thing divided by cost of equity. Dividend we got, how much? 0.2. R and cost of equity is same. How much is that? 10%, which is 0.1. This is 0.1, 0.1 into E minus D. E is how much? EPS 10. D is 0.2. Solve. How much are you getting? 100 rupees. If you want, you can prove it for yourself. Okay, sir. Shapa. I know, Shapa. Now, can we assume another one? Let's assume dividend payout ratio is 30% now. 30% of what? EPS. How much is EPS? 10 rupees. Now, I've assumed 30% of EPS is given as dividend. Will the price should change or still it should be 100? R is equal to cost of equity. So, price should not change. So, let's see at 30% are we getting same answer or not? E is 10 rupees. 10 ka 30% is how much? 3 rupees. So, dividend now will become 3 rupees. Plug in this number in formula. D, which is 3, plus R divided by cost of equity. Both are 10% into E minus D. E is how much? 10 rupees. D is 3 rupees. Solve. How much are you getting? 10 rupees. So, that means whatever is your dividend payout ratio, price will always be 100. This scenario will hold good only when what? R is equal to cost of equity. This you don't have to prove it in exam, people. Okay, just for our reference sake, we've just put it up. Second requirement also done. Can we now go through the third requirement? What else they ask for? What is your decision if P multiple is 8 instead of 12.5? Here they gave 12.5, no? Now they said instead of 12.5, make it as 8. I faltu no. Sir, if P multiple is 8 means what will be cost of equity? 1 divided by P multiple. 1 divided by 8. How much is that? 12.5 will be your cost of equity. What is R? R is still 10%. Now you check. R is 10. Cost of equity is 12.5. R is greater than cost of equity or lesser? What is optimum dividend payout ratio? 100%. 100%. So that's what you need to say. And if you want also, you can solve. What will be the price of the share if optimum dividend payout ratio is followed? Dividend payout ratio should be how much? 100% of EPS. How much is EPS? 10 rupees. 100 ka 100% of 10 is how much? 10 rupees only. So dividend will become 10 rupees. R is 10%. Cost of equity is 12.5% into E. E is your 10 rupees. Dividend is also 10 rupees. Divided by cost of equity, if you do, you will get the answer to be 80 rupees. This is the optional. If you want to do, you can, or you can stop it at the theory level only. Since R is lesser than cost of equity, optimum dividend payout ratio should be 100%. Leave there or also do the price calculation also, your call. Done, Sarji? Yes, sir. Okay, sir. Now, one last question. and chapter over. Can we review? A pakka over, God promise. You're looking at me differently. Pakka. That's it, over. Nothing else. Now you remember dividend discount model. It was there in the chart book. This fancy formula. Right? Okay. Now dividend discount model is not tested since many attempts, people. So till it is tested, it will always be there as an LDR for me. LDR means last day revision. Better to review that. My gut feel is next 1 or 2 attempts it will come. This attempt only. Tatastu, it will come. 5 marks question. Okay, now. And now people, dividend discount model, or they will say find out the intrinsic value of the share. Find out the intrinsic value of the share, they will say, or they will say use the word dividend discount model. Here under dividend discount model, if you want to find the price of the share, that's given by the formula D1 divided by 1 plus cost of equity whole power 1 plus D2 divided by 1 plus cost of equity whole power 2 plus D3 divided by 1 plus cost of equity whole power 3 plus D4 divided by 1 plus cost of equity whole power 4 plus so D5 divided by cost of equity minus growth rate into 1 plus cost of equity whole power 4. This is the formula. Yeah. But you don't have to remember this. You don't need this. Without formula, we will solve. Okay, Naji? Okay. And I prefer to solve this particular model without formula only. Why? Because my gut feel is they may ask you this as an MCQ question. This is a very good question for MCQ. You can build 3, 4. In fact, that is there. One question we have solved in our regular notes. It was an MTP question or previous MTP question. It was there in our class notes. Now we're going to solve study material question because it will help the non-regular students of us so that at least they'll find the question. But I'll tell you why without formula I prefer. Maybe first we will take up the question. That will give you a little better context. Question number 20. Study material question. It is there. Maybe it is there as a TYK, test your knowledge question, I think. I don't know where it is there, but it is there in study material. That much I know. Okay, now, okay, check here everybody. A and R Limited is a large multinational company. Okay, their problem. How much is the face value? 100. The company, read this line carefully. Company is expected to grow at what rate? 15% per annum only for the 4 years. Infinite period only for 4 years. First 4 years or next 4 years it will grow at 15%. After that it will grow at 5% for indefinite period. For first 4 years growth rate is 15. Thereafterwards infinite growth 5%. Okay. Shareholders expect how much return on their investment? 20%. So for a shareholder, it is a company. For a company, it is for a shareholder, it is a return. For a shareholder, it is a return. Now, if you give money to Infosys, if you as an investor buy Infosys ka shares, for you, it's a return. For a company, it will be a cost. Yes, no, one person ka return is another person ka cost. Just like debtor-creditor relationship in accounts, a return for one person will become cost for another person. So how much return equity shareholders are expecting? 20%. That only we call it as cost of equity. No, return expected by equity shareholders only we call it as cost of equity. Given as how much? 20%. Company paid, expected. Company paid 120 as dividend for 2021 year. So this is already paid. Already paid means D1 or D0? D0. Shares of the company are traded at an average price of 3122 on the last day. If you check the market price of the shares in the stock exchange, what is the price? 3122. You need to find out intrinsic value of the share and tell whether the share is overpriced or underpriced. We'll talk about this later. We need to find out intrinsic value of the share. Brospati, don't write 3122. Sir, already given, sir. This is the market value of the share. Okay. We need to find intrinsic value means book value per share. These two value will not be same. Okay, we need to compare and then say share is overpriced or underpriced. So this we need to find. Sometimes they will say intrinsic value or sometimes they will say find out value as per dividend discount model. One and the same. Pretty easy question. Now people, if you are a shareholder, at best you will get two things. if you are an equity shareholder, you will get two things from the company. Can you tell me what is that? Dividend. And when you sell the shares, eventually you will get the money. Correct? All this you will get immediately or in future. Find out the present value of that. That is only intrinsic value. Because dividend you will not get now. You will get over many years. If you are planning to hold the shares for 10 years, means you will get the dividend for 10 years. So that is a present value or future value? Future value. Find out first, find present value of dividend. First find what? Present value of dividend. Later you will sell the shares. When are you planning to sell the shares? 10th year, right now. So that means you want 10th year ka value or today's value? They are asking intrinsic value after 10 years or now? Now that means find out the present value of the price of the share. These two if you add automatically, it is nothing but what? Intrinsic value. That is what that formula is telling. To calculate present value, we need formula, na people. We already know the table. Tell me what is the table? Year, cash flow, discount factor, congratulations, 20%. Present value of cash flows. Okay. First, we have to find present value of dividend. We have to find present value of dividend. How much dividend already paid? 120. Now, here they have given two growth rates. For the first 4 years, how much? 15%. Thereafter, it will grow at 5%. This 5% will grow for how many years? Indefinite period. So, how much you will take? Don't know. This 5% can we take? No, this is for infinite period. So, we don't know, right? But the dividend will grow at a constant rate up till which year? 4th year. That means we have to stop our calculations at 4th year because there afterwards it is infinite. Okay, na sir. Hence, we will stop at which year? 4th year. Why 4th year? Dividend is 15% is constant only up till 4th year. Okay. So, find out the dividend for 4 years. They have given D0. They have given D0. What will we find? D1, D2, D3, D4. All these are present value or future value. Multiply this by what? Discount factor. What are we going to get? Present value of dividend. Agreed? Now, how much dividend already paid? 120. This is D0 and dividend will grow for 4 years at what rate? 15%. So, what will be D1? 120 plus 15%, 138. This is your after 1 year dividend. For year 2, what will be the dividend? Take 138, again add 15%. 158.7. Third year ka dividend will be this number plus 15%. 4th year, this number plus 15%. This is your next 4 years ka dividend. Agreed? Present value or future value? These number. Present value or future value? Future value. But are we finding intrinsic value in future or now? That means we need future value or present value. How do you, from future value, how do you get present value? Multiply discount factor. How much is the shareholders expecting? 20%. Right now, that is your discount factor because discount factor is after tax cost of capital. In PV also we have done. Discount factor is nothing but after tax cost of capital. Here, how many sources of capital we have? Only one, which is what? Cost of equity. Hence, cost of equity only will become discount factor, which is given as how much? 20%. Sir, all years ka discount same or different? If it is different, can we use PVAF or PVIF only? PVIF. At 20%, give me discount factor for each year. 1 divided by 1.2. I have taken 2 decimals. 0.83. Again, press go on, pressing equals to button. You will get the discount factor. Multiply these two. This is your future value. This is your discount factor. Multiply to get the what? Present value. Okay, na sir ji. What is the total present value of dividend? Everyone got it? Pakka got it? Yes. This is what is first line of the formula trying to calculate. This portion of the formula, what we just did now, no? This is first part of the formula. If you want check, D1 divided by 1 plus cost of equity. What? Cost of equity here is nothing but I. What is discount factor? 1 divided by 1 plus I whole power n. I, they have substituted with cost of equity. For first year, what is n? 1. For first year, what is n? 1. For second year, what is n? 2. Third year, what is n? 3. Or fourth year. That means basically they have taken dividend. There's nothing but this formula, if you have to rephrase, it is nothing but D1 into 1 divided by 1 plus cost of equity whole power 1. So what is this? Discount factor. They have taken first year ka dividend, expected dividend, and multiplied first year ka discount factor. Here what have they done? taken second year ka dividend and multiplied second year ka discount factor. Third year dividend and third year ka discount factor. Fourth year dividend, fourth year ka discount factor. We need this or we know this. We know this. That means adding all this, what are you going to get? So basically, you'll get the present value of expected dividend. So now really tell me formula is required. Now without formula, aram se we can solve. Yes or no, sir? Correct. Now if need a minute or okay till here. Now if you are a shareholder, you will only get dividend or also you will get money when selling. Money while selling. Here dividend after 5th year, it will grow at infinite period. Now we don't know what is that infinite period is. So we'll have to stop all the calculation which year? 4th year. So I'll have to find price of the share for which year? 4th year. Correct. This also you know. People, how do you get P naught as per Gordon sir's ka growth model? Tell me. Here there is growth rate, no? Which is the only formula which uses growth rate? Gordon Chicha. Tell me P naught ka Gordon sir's ka formula which uses growth rate. D1 divided by KE minus G. Yes, Ajay. Paka? Now check ko. If you want P naught, you will take D1 divided by KE minus G. KE will remain constant. Growth rate is also constant. Similar way, if you want to find P1, what will be the formula? For P naught, this is D1 means. For P1, it will be D2 divided by cost of equity. If you want to find P2 means D3 by cost of equity. We want P3 or P4. For P4, what will be the formula? D5 divided by cost of equity minus growth rate. Yes, sir. Correct. First find that. And now we have D5 or we have only up to D4? We have D4. So what will be D5? No, don't add 15%. Prabhu. From 5th year onwards, growth rate is not 15%. From 5th year onwards, growth rate is not 15%. Macha, it is 5%. It is 5%. They told from 5th year onwards, it will grow by 5%. So what is D5? Take 4th year cut dividend and add 15% or 5%. You will get 220.29. Done, Aji. Cost of equity already given. How much is cost of equity? 20%. Growth rate now don't take 15%. It is 5%. Substitute, you will get P4. How much is that? Satisfied? Taka, you're doing your calculator. You're getting the same number. So you got the price of expected price of the share. How much? 1468.60. Okay, na sir. This is the price of the share now or after 4 years? After 4 years. Are you finding intrinsic value after 4 years or now? I mean, this is what value? Future value. As a shareholder, you will also get, when selling the shares, you will get this. But this is future value. But we need the value now. So what do we need? Present value. This is the future value. How do we find from the future value present value? Take this number and multiply discount factor. 1 second. 5th year ka discount factor or 4th year ka? Sir, this is 4th year ka price. So you will multiply 4th year ka discount factor. 4th year ka discount factor you already know. 0.48. Multiply. 704.9. What is this? Present value of expected price. As a shareholder, you can only get two things. Dividend and price. What is the present value of expected dividend? 428.76. What is the present value of expected price? 704. Add it, you will get intrinsic value of the share. That's all. Tell me, one formula also did you use? No. It is simply future value and present value calculation. That's all this formula also trying to calculate. Done now. Everybody got it, Pakkana ji. What is the intrinsic value you got, sir? 1133.68. Yes, sir. But currently, the shares are trading in the stock market at what price? 3122. Stock market price is 3122. But as per us, the value should only be 1133, but it is 3122. That means shares is underpriced or overpriced. So this share is overvalued by these two ka difference. How much is it overvalued by? 1988.32. Clear? Now look at the formula if you want. I think you already know first part of the formula. What is this, people? This portion is what? This portion is what? What is this trying to calculate? This is the present value of the dividend. Because there is nothing but dividend multiplied by discount factor. Dividend multiplied by the discount factor. How many years ka? 4 years. Okay. And then, okay, that's first part. That's what our first table did. Next, what did we calculate? Price of the share. Which year? 4th year. Why 4th year? Because after 4th year, growth was definite or infinite? Infinite. So we stopped our calculation at 4th year. How do you find 4th year ka price? If you're confused, go for Gordon Chicha. P0 is equal to D1 divided by K minus G. Similarly, P4 is equal to D5 divided by K minus G. By doing this, what are you going to get? P4. P4 means price now or after 4 years. I mean, what is this? Future value. But we need future value or present value. And so you have to multiply by what? Discount factor. Which year ka discount factor? 4th year. How do you get discount factor for 4th year? 1 divided by 1 plus I whole power n. N is 4. Instead of I, they have substituted with cost of equity. Because anyway, discount factor is cost of equity here. So that's what they asked. Done. Okay, now I'll just show you the chart book. Why I prefer solving without formula is, I think I have written that somewhere. Why to write once again? Here. This is a formula. This part of the formula captures what people? Present value of expected dividend. This part of the formula captures what? By doing this, what are we going to get? Price of the share at the end of 4th year. What is this? Discount factor for year 4. Okay. That means by adding all, basically by multiplying these two, what are you going to get? You will get the present value of the share at the end of, you will get the present value of the share. By adding these two, totally you're going to get the intrinsic value of the share. Correct? Why do I prefer solving in the normal table fashion without formula is, in one's RTP, I think, or MTP, I don't know, right? What they asked us, they gave the same question, not as a descriptive question, but they gave the same question and they are asked the question in MCQ format. You know what and all they asked? What is the present value of expected dividend? What is the present value of expected dividend? Now tell me, if you use formula, what is present value of expected dividend? If you do normal way, our first table ka total is nothing but present value of expected dividend. Straight away tick. But in formula, if you use, you can use, but you should know the meaning of formula. This portion of the formula captures present value of expected dividend. So that is 2-mark question. Then they asked price of the share by the end of 4th year. What is the price of share at the end of 4th year? Which portion of formula captures that? This. They asked this for 2 marks. Then they said, what is the present value of market price? How do you get present value of market price? By multiplying these two. That is one requirement. Then they asked finally, what is the intrinsic value of the share? That will be the total number. So using the same formula, they asked 4 questions. But when we solve individually, we know the answer for each component because that's the way we are solving. But in formula, you will get the answer as 1. So that's the reason I don't prefer to solve using this method. I prefer to solve using the normal way without formula. Go in the, got it. Okay. I thought one of us will break. Looks like I only have to break. Okay. Fine, people. I think we have done all the questions that I had in mind for this particular topic. Thank you for your time and patience.